Good evening, wherever you are in the world. Tonight, we need to talk about something that most headlines are still failing to describe accurately. What we are witnessing right now is not a normal economic slowdown. It is not a regional crisis. It is not a temporary correction that will simply resolve itself with time. This is something deeper, more structural, and far more consequential. The global financial system, the one that has underpinned growth, stability, and capital flows for decades, is beginning to fracture in ways that are subtle, technical, and therefore dangerously easy to ignore. On the surface, markets appear calm. Equity indices continue to trade near historical highs in some regions. Volatility measures remain compressed. Credit spreads, while wider than before, are not screaming panic. To the casual observer, this looks like resilience. But resilience is not the same as stability. And beneath this surface calm, pressure is building in the most critical part of the financial system, the plumbing that moves money, prices risk, and funds governments. Start with sovereign debt. For years, government bond markets were the anchor of global finance, predictable, liquid, and implicitly trusted. That anchor is no longer holding in the same way. Across advanced economies, yields have risen not because growth is booming, but because the cost of borrowing itself is being repriced. This is a crucial distinction. When yields rise alongside strong productivity and expanding incomes, the system can absorb the shock. When yields rise because investors are demanding compensation for inflation persistence, fiscal strain, and policy uncertainty, the implications are very different. Governments today are carrying debt loads that would have been considered extraordinary a generation ago. Servicing those debts was manageable when interest rates were pinned near zero, and central banks were active buyers of last resort. That era has ended. As rates normalize, and in some cases overshoot, the mathematics of public finance begins to change. Interest expenses grow faster than revenues. Refinancing becomes more sensitive to market sentiment, and small shifts in confidence translate into large moves in yields. This is not theoretical. It is visible in auction results, in bid-to-cover ratios, and in the growing reliance on short-term issuance to manage long-term obligations. When governments roll debt more frequently, they expose themselves to market stress with far greater intensity. Liquidity, once taken for granted, becomes conditional. At the same time, the buyers that once stabilized these markets are stepping back. Central banks, after years of expanding balance sheets, are now constrained. Inflation has forced a reversal in policy priorities. Where once the focus was on supporting growth and preventing deflation, it is now on restoring credibility and controlling price stability. This shift has consequences. Central banks are no longer absorbing supply at the scale required to offset expanding fiscal needs. Private markets must fill the gap, and they are demanding higher compensation to do so. This dynamic is rippling outward. Bond markets do not exist in isolation. They are the reference point for virtually all other asset classes. Higher sovereign yields reprice corporate borrowing. They alter equity valuations by changing discount rates. They affect currencies by shifting interest rate differentials and capital flows. What begins as a technical adjustment in one market quickly becomes a systemic recalibration. Currencies in particular are responding to this tension. Exchange rates are moving less on trade fundamentals and more on capital mobility. When yields diverge, capital follows. When policy credibility is questioned, currencies weaken. And when volatility rises, leveraged positions unwind rapidly. These moves are often sudden, nonlinear, and difficult to contain once they begin. For retail investors, much of this remains invisible. Portfolio dashboards still show gains. Headlines still emphasize earnings beats and soft landing narratives. But markets are not warning systems designed for clarity. They are pricing mechanisms that often signal danger only after thresholds have been crossed. By the time stress is obvious to everyone, it is usually already embedded in funding costs, liquidity conditions, and risk premiums. The illusion of calm is reinforced by familiarity. Many participants are anchored to the patterns of the past decade, a period defined by abundant liquidity, predictable policy responses, and rapid intervention at the first sign of stress. That memory is shaping expectations in an environment that no longer supports it. The old reflexes are still there, but the tools are weaker, the constraints tighter, and the margin for error much smaller. What makes this moment particularly fragile is that multiple pressures are converging simultaneously. Fiscal expansion is colliding with monetary restraint. Demographic shifts are reducing natural savings pools. Geopolitical fragmentation is disrupting capital efficiency. And the global system, once optimized for speed and scale, is becoming more segmented and less forgiving. None of this unfolds in a single dramatic collapse. It emerges through strain, in funding markets that seize up briefly, in auctions that clear but at higher costs, in policy statements that grow more cautious and less reassuring. These are not isolated events. They are signals of a system adjusting to new constraints. And as this adjustment accelerates, the risks extend far beyond trading desks and investment portfolios. Higher borrowing costs feed directly into public spending choices. They influence infrastructure investment, social programs, and long-term growth potential. They shape labor markets, housing affordability, and the cost of basic goods. Financial stress, when sustained, always finds its way into the real economy. What we are seeing now is the early phase of that transmission. Not a crisis headline, not a singular shock, but a slow reconfiguration of how risk is priced and who bears it. The system is still functioning, but it is doing so under increasing tension. And history suggests that when tension becomes the defining condition, stability becomes conditional. The question is no longer whether change is coming. It is whether the adjustment will remain orderly. And who will be prepared when the assumptions that once defined safety no longer apply. That conditional stability is already reshaping behavior at the highest levels of global finance. Policymakers are speaking more carefully now, not because risks have diminished, but because the room to respond has narrowed. Every rate decision, every balance sheet adjustment, every forward guidance statement is weighed against constraints that did not exist in the same way before. Inflation remains above comfort levels in many economies, yet growth is slowing. Financial conditions are tightening, yet debt burdens require accommodation. These forces pull in opposite directions, and the tension between them is becoming increasingly visible. In previous cycles, central banks could act decisively. They could cut rates aggressively, inject liquidity, and reassure markets with near certainty that support would arrive before damage became systemic. Today that confidence is fractured. Credibility, once built on stimulus, is now built on restraint. And restraint carries costs. When markets believe that central banks are limited in their ability to intervene, risk must be priced more honestly. That repricing is rarely smooth. Liquidity, the lifeblood of modern finance, is where this shift is most apparent. It does not disappear all at once. It thins. Bid-ask spreads widen quietly. Market depth evaporates during moments of stress. Assets that once traded freely begin to gap on relatively modest flows. This is not panic, it is fragility. And fragility changes behavior. Institutions reduce exposure. Dealers hold less inventory. The system becomes more sensitive to shocks that would once have been absorbed without incident. At the same time, leverage remains embedded in the structure of global markets. Years of low rates encourage borrowing against stable assumptions. Those assumptions are now being tested. As funding costs rise, leverage becomes less forgiving. Positions that looked prudent under one regime become vulnerable under another. When adjustments occur, they are often forced, not voluntary. Margin calls do not wait for consensus. This dynamic explains why periods of apparent calm can coexist with sudden episodes of stress. Markets are not signaling confidence, they are signaling compression. Volatility is suppressed not because risks are absent, but because participants are positioned similarly, relying on liquidity that may not be there when it is needed most. When positioning becomes crowded, small disturbances can produce outsized reactions. The interconnectedness of markets amplifies this effect. A shift in bond yields alters currency valuations. Currency movements affect corporate balance sheets, particularly in economies with foreign-denominated debt. Equity markets respond not only to earnings expectations, but to changes in financing conditions and capital availability. These links are not linear. They reinforce one another, sometimes with little warning. Consider the role of the US dollar, still the central axis of global finance. Dollar strength tightens financial conditions worldwide. It raises the cost of servicing debt, drains liquidity from emerging markets, and forces policy responses that may conflict with domestic economic needs. Yet dollar weakness carries its own risks, signaling potential instability or loss of confidence. In either direction, the adjustment is disruptive. What makes this environment particularly complex is that traditional signals are less reliable. Yield curves have distorted meanings. Equity valuations are influenced as much by liquidity dynamics as by fundamentals. Credit markets reflect both genuine risk assessment and technical constraints. Interpreting these signals requires acknowledging that the system itself is in transition. For households and businesses, these shifts manifest gradually. Loans become more expensive. Credit availability tightens. Investment decisions are delayed. Hiring slows. These are not dramatic events individually, but collectively they alter economic momentum. The effects are uneven, felt first in interest-sensitive sectors and regions with less fiscal flexibility. Governments face difficult trade-offs. Supporting growth through spending becomes more expensive as borrowing costs rise. Cutting spending risks social and political backlash. Raising taxes can suppress already fragile demand. These choices are constrained not just by economics, but by market tolerance. Investors are increasingly sensitive to fiscal trajectories, and that sensitivity can change quickly. The assumption that sovereign debt is risk-free in practice, if not in theory, is being challenged, not through defaults, but through volatility and uncertainty. When government bonds themselves become a source of instability, the implications ripple across the entire financial architecture. Pension funds, insurers, banks, all rely on these instruments for stability and collateral. Stress in this foundation reverberates widely. Retail investors, meanwhile, are often the last to adjust expectations. Many entered markets during an era when declines were brief and recoveries swift. That experience shaped a belief in perpetual support. But systems evolve. The conditions that made that pattern possible are no longer dominant. Recognizing that shift is uncomfortable, because it requires abandoning familiar narratives. What we are witnessing is not the failure of markets, but the reassertion of constraints. Capital is no longer free. Risk is no longer easily deferred. Time horizons matter again. These changes do not announce themselves with alarms. They emerge through recalibration, slow, uneven, and often misunderstood. As this recalibration continues, the margin for policy error narrows. Small missteps can have large consequences when buffers are thin. Communication becomes as important as action, yet words alone cannot create liquidity or restore confidence indefinitely. Trust must be earned in an environment where outcomes are uncertain and trade-offs unavoidable. The global financial system is still operating, still processing transactions, still allocating capital. But it is doing so under conditions that are fundamentally different from those of the past decade. Understanding that difference is essential because it defines what is possible and what is no longer guaranteed. Those guarantees are fading not because of a single policy mistake or an isolated shock, but because the framework that supported them is no longer intact. The post-crisis world was built on coordination. Between central banks, between fiscal authorities, between markets that trusted intervention would arrive when needed. That coordination is now weaker. National priorities are diverging, political pressures are rising, and economic resilience is being tested in ways that cannot be resolved by liquidity alone. Global trade, once a stabilizing force, is increasingly shaped by security concerns and strategic alignment rather than efficiency. Supply chains are being redesigned for resilience, not speed. That shift carries costs. It raises prices, reduces margins, and alters capital allocation decisions. Over time, it also feeds into inflation dynamics that are harder to suppress without slowing growth. These are structural forces, not cyclical ones, and they interact directly with financial conditions. Demographics add another layer of strain. Aging populations in major economies are changing savings behavior, labor supply, and fiscal demands simultaneously. As workforces shrink, productivity must rise just to maintain existing standards of living. As retirees grow in number, public spending pressures increase while tax bases narrow. These trends were manageable when borrowing was cheap and growth was strong. Under tighter financial conditions, they become sources of persistent tension. The private sector feels this adjustment unevenly. Large institutions with access to capital markets adapt more quickly. Smaller firms, households, and local governments face sharper constraints. Credit differentiation increases. Risk premiums widen selectively. The economy becomes more segmented, with pockets of resilience alongside areas of acute vulnerability. This fragmentation reduces the effectiveness of broad policy measures and complicates stabilization efforts. Financial innovation, often viewed as a solution, can amplify risks in this environment. Complex instruments, leveraged strategies, and opaque interconnections thrive when volatility is low and liquidity abundant. When conditions tighten, they can accelerate stress rather than absorb it. The speed of modern markets ensures that adjustments occur faster than regulatory frameworks can respond. None of this implies an imminent collapse. Systems rarely break all at once. They strain, adapt, and sometimes fail in specific segments before stabilizing elsewhere. The danger lies in misinterpreting endurance for immunity. Just because the system continues to function does not mean it is healthy. Just because markets clear does not mean they are efficient. And just because crises have been avoided so far does not mean the risks have dissipated. What makes this moment particularly consequential is that expectations themselves are shifting. Investors, policymakers, and institutions are beginning to operate under a different set of assumptions. Risk management is becoming more conservative. Time horizons are shortening, optionality is valued over optimization. These behavioral changes reflect an implicit recognition that the environment has changed, even if the narrative has not fully caught up. For societies, the implications extend beyond economics. Financial conditions influence political stability, social cohesion, and trust in institutions. When growth slows and costs rise, pressures surface. When public resources are constrained, choices become more visible and more contentious. The financial system does not exist apart from these realities. It transmits and amplifies them. The challenge ahead is not simply managing volatility, but navigating a transition without clear precedents. The world is moving from an era defined by excess liquidity and centralized support to one shaped by scarcity, fragmentation, and constraint. That transition will not be smooth, and it will not be evenly distributed. Some will adapt quickly, others will struggle. What remains uncertain is not whether change will continue, but how it will be absorbed. Will adjustments occur gradually through policy coordination and structural reform? Or will they be forced by market stress, sudden repricing, and loss of confidence? History offers examples of both, and rarely are they clean or predictable. As viewers of this moment, wherever you are in the world, it is worth recognizing what is unfolding beneath the surface. Not a headline crisis, not a single turning point, but a slow recalibration of the system that governs money, risk, and trust. The signals are there, embedded in yields, in currencies, in policy language, and in behavior. The global financial system is not ending, but it is changing in ways that challenge assumptions built over decades. Stability is becoming conditional, certainty is becoming rare, and the distance between calm and disruption is narrowing. The world is adjusting to a new set of rules, even if they have not yet been written down. And until they are, uncertainty will remain a defining feature of the landscape we are all navigating.